So I talk about various advanced tax planning strategies in my book, and normally these strategies are beyond the scope of CPA or accountant. So any advanced tax planning strategies for high income earners are basically, you can put it in a three bucket. One is recategorizing the income. The second one is using some sort of the retirement or employee benefit plan. And the third one is to use some sort of tax efficient, tax advantageous investment, basically. These are the main three buckets you use for the advanced tax planning strategy. Let's talk about a little bit more in terms of the recategorizing the income. So we know that primarily there are two kinds of income high earners receives. One is W-2 income, and second one is that there comes as a profit from the business, right? So say if you are an employee and working for some employer, and say for example you receive $1 million or the $2 million W-2 income, there are some limitations on your part to put some advanced retirement-based strategy, because those are strategy primarily put in by the employer, and here you are being the employee, you don't have a lot more leeway to put those kind of strategy, but it doesn't mean you can't use some other investment-based strategies, so that we will talk a little bit more about that one. If you are small business owners and making good money, then obviously there's quite a bit strategy that you can use and take substantial income tax deduction. And finally, the investment-based opportunities can be used for the self-employed, small business owner, as well as some of the W-2 employee high-income earners. The retirement or the employee benefit-based strategies are normally falls under the pension plans or the retirement plan. There are primarily two kinds of planning. One, it's called the defined contribution, and the another called the defined benefit. So defined contribution, as the name suggests, that's where the IRS defines the contribution. How much you can contribute in a pre-tax dollars, basically. So that's where normally capped in 2019, somewhere around $56,000 or 25% of your FICA eligible compensation. On the other hand, defined benefit plan, that's where the IRS doesn't define how much you can contribute, but how much benefit you can take it when you are at the retirement. So in 2019, IRS allows you to take $225,000 in retirement benefit. So that's where you need the actuary or the pension attorney to calculate how much deduction you can take it. So primarily it is based on your last 3 years income, numbers of years before you retire, and any money in your existing defined benefit plan. So based on that one, actuary or the pension attorney will come up with the contribution numbers. But in a nutshell, defined benefit plan will allow you to take a much higher tax deduction than defined contribution plans, such as the profit sharing plan or the SEP plan or 401k combined with the profit sharing plan. By the way, you can also combine 401k plan with defined benefit plan. So it's going to help you take additional, 18 to 23, depending what age you are in, over and above the defined benefit plan. So here, with a defined benefit plan, you can take anywhere from $150,000 to, I have some client who takes almost $300,000, $400,000 annual income tax reduction. There are some other advanced tax planning strategy also out there, and that I do talk in my book. Some of them are aggressive, but if a client is in the agreement, then you can put in those, and that those strategy will allow you to take much more higher tax deduction. I mean, $500,000, $1 million a year, basically, and more if you so choose to. So those are some of the strategies. Those are the advanced, a little bit aggressive strategy. Client needs to understand in details. You need the team of obviously your CPA somebody like me, you that also need the team of the tax attorney if you need to create some trust or some entity or so on and so forth, and you also need the actuary or the pension attorney to calculate some of the benefits basically. So those are some of the advanced tax planning strategy. Those are based on the either retirement or employee benefit aspects. So whenever we are talking about advanced tax planning strategies, most people think so in terms of how much tax deduction I can take it today, or how can I reduce my tax burden today. I believe one need to look at holistically, not today, but in next 5 years, next 10 years, next 20 years, or when you retire and when you're taking those money out, or when you are continue to spend those money for your own lifestyle purpose, right? Because if you don't do it right, it may happen. You might get the much higher income tax deduction today, but when you retire and when you're taking those money out from that, you will end up paying much higher taxes at that time, basically. So the smart tax planning strategy involves income tax deduction today and the tax-free retirement in future when you retire. So depending on what the income tax rate is at that time, and that we have talked in my other videos, and I do talk in my book also, that currently, even though it feels like that one we are paying too much in taxes, but currently we are in the lowest tax rate environment. If you look at historically from 1930 until today, the average tax rate in the US, it's a 58%. Today we are paying 37%. So we want to make sure that when we retire or when we are ready to use those money, we are not in 58% tax rate, right? We are still in the lower tax rate, and that even though if tax rate happens to be those higher, you still have some tax-free income available at that way. So the smart strategy you want to do is the combination of higher income tax deduction today and the tax-free income in the future. And if you're not able to take the higher income tax deduction today, you can put some strategy where you can capture back those lost tax dollars later on in a life by using some other strategies as well. If you can do this one, you will be much happy camper by earning much more dollars and keeping for yourself as well. Many a time to implement this kind of strategy, you need a team of the right people. So obviously you need your CPA or the accountant, somebody like me. Over and above, you probably need the tax attorney to either create new entities or restructure existing one or create some trust. We also need sometimes some, either actuary or the pension attorney to calculate some of the benefit. Even though it sounds like a lot and it might cost a lot, but if you are in that income range, then that I can tell you the fees you pay to these people is really minuscule compared to the tax benefit you will receive. So that rather having the right team in your corner for this kind of advanced tax planning strategies is paramount important.